makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The U.S. pauses a shipment of bombs to Israel over concerns about damage to urban areas as Israel inches into Rafah. Siemens Energy and brewing giant AB InBev surge after strong results as global stocks continue to stage a comeback. Plus, the U.S. revokes licenses allowing Huawei to buy chips from Qualcomm and Intel as Washington tightens curbs against the Chinese phone maker. So first thing is first, let's take a look at the European markets map. It has been a pretty strong week, actually, so far in terms of earnings, and it's very clear that equities are enjoying that. So they're all ticking higher. We had some strong company reports. Also, traders, of course, seeking some of the evidence of earnings recovery before taking this month's rally further. The dollar's gaining, and of course, what's also been supporting a lot of these equities is what we've seen. Really, the prospects of Fed rate cuts. And again, the pace of advance seems to be easing, and that's, in general, pretty equity supportive. Now, we'll continue watching markets very closely, but really our main story is what's happening on the ground in the Middle East. The U.S. paused a shipment of bombs to Israel last week over concerns about plans for a full-scale assault on Rafah. Meanwhile, Israeli forces are edging closer to the city in southern Gaza, with truce talks stalling. Now, Washington says Israel and Hamas should be able to resolve their differences over a proposed ceasefire. We're now joined by Rosalind Matheson, Bloomberg's EMEA news director. So, Ros, what's the latest that we know of?
Well, we know that the US has paused this shipment, and these are bigger bombs, heavy bombs that could do damage potentially in highly densely populated areas. And the US concern there very much is those bombs could end up being used in Gaza, particularly in Rafah. So it's a pretty symbolic move from the US. It's not unprecedented, but they're certainly sending a further signal of their concern about what a Rafah offensive might look like and the potential risk to civilians in the area. They are saying they're going to proceed with the rest of their aid shipments, their military aid that recently agreed significantly large package that includes stuff that will help Israel with its own defence. So, for example, supporting the Iron Dome missile shield and so on. So they're not pulling away from military support for Israel as a whole, but they're sending a message to Israel with this particular pause in sending them these heavier bombs. And that really is that level of concern that we're seeing Israel edge forward, move forward bit by bit towards that fully fledged Rafah offensive. We've seen them move in to take control of the Rafah crossing into Egypt. We've seen, airstrikes going on in the eastern part of Rafah. We're seeing further activity on that front this morning. So we are getting bit by bit towards that full offensive. Perhaps it will be a slow walk towards there, but it's coming either way. And so the US is really concerned about that and certainly doesn't want its big bombs being used.
Ros, how difficult is it to understand what civilians are doing right now, where they can go to? It's very difficult, of course, to track because of the limited access to the area.
It's very difficult to tell. We do see some satellite imagery which shows that tents are being set up further north from that area in eastern Rafah. We can see some initial signs of movement of people, but it's really difficult to tell the size of that, the number of people who might be relocating. And obviously, either way, it's going to be a very, very slow process. They're not compelling people to leave. Israel is encouraging people to leave and saying they suggest they move north out of harm's way. And that's only from one section of Rafah at the moment. Do you get to the point where they're going to tell everybody in Rafah city itself to leave? And that's more like 1 million people, and you can't move 1 million people in a hurry. So the suggestion is that we're not going to get to a full-fledged Rafah offensive in a matter of days. It could, in fact, be weeks.
Rosalind, thank you so much. Ros Matheson there, Bloomberg's EMEA news director, of course, on the latest on the ground. Now, European stocks have been staging a comeback so far this month. Traders on the lookout for firm evidence of an earnings recovery before taking the rally further. Well, joining us now is Nataliia, Lipikhina, head of EMEA equity strategy at JPMorgan Private Bank. Also with us is Justina Lee. So thank you both for joining us. Nataliia, welcome to the Pulse. Delighted to have you here today, especially on such an important day for earnings. It seems a lot of them are actually better than expected. It's like an earnings recovery, and that's filtering through to equities.
Yeah, absolutely. Thank you. Very excited to be here. Coming to this year, we were actually very positive on the equity markets. And the reason for that was the rolling earnings recovery. We think that earnings are bottoming here in Europe, and they're recovering in the second half of this year. And same for the US. We think that earnings are likely to recover from here. When we look into the beats and in general what different sectors are doing, in the US, we're actually seeing that 11 sectors are having beats, and they're posting better than expected earnings growth. That is definitely posing some optimism in the market. And in Europe, even though some companies don't really raise guidance, we're really seeing that market is expected the growth to accelerate from the second half of this year.
And Nataliia, is this quality growth? Is it cost cuts, or is it actually that they're growing in the right business, and this is thanks to a growing economy?
Yeah, exactly. If you look into for example, last year, the story was predominantly driven by tech. Right now, we're seeing the broadening of that performance, especially from the earnings perspective, which is crucial to the market because this is exactly what the market wanted to see. The market wanted to see that earnings in different sectors, not just tech, are delivering. And we believe that we're going from the rolling earnings recession concept to the rolling earnings recovery. So if you look into COVID times, COVID created a bit of instability and a bit of deceleration in many sectors at a different time. So you really did not see it at the index level. But now you're seeing that a lot of sectors are done with the normalization post-COVID and now reaccelerating from here.
And Justine, also what's supporting this is, of course, I know expectations for the Fed are all over the place, but now we're maybe expecting more cuts than even 2 weeks ago. And then we also in Europe had already 2 cuts and are expecting more maybe from the ECB in June.
Right, exactly. I think in Europe, people are already looking ahead that maybe the economy will get a bit of support from the rate cuts. In the U.S., it's sort of an interesting picture because if you look at the jobs data, but also some of the other prints, it would seem like there might even be some stagflationary worry, shall we say. And I think that kind of really is confusing people at the moment. And I think that's because a lot of the underlying drivers of inflation right now are not entirely just about, demand. For instance, like Kashkari kind of highlighted the lack of progress on housing costs in particular. And some of that is about supply. And so that kind of raises the question of, what should monetary policy do about that?
And Justina, here's Neil Kashkari, who we spoke to yesterday.
I think the most likely scenario is where we are right now, which is just we stay put for an extended period of time until we get clarity on is disinflation in fact continuing or has it in fact stalled out. I don't think we know the answer to that, so I would say the most likely scenario is we sit here for an extended period of time.
So Justina, what does sitting here for an extended period of time look like for the markets?
Yeah, I think kind of what he is highlighting here is that it could be that the neutral rate of interest, where kind of the economy is neither expanding nor shrinking. I mean, it could actually be higher than what markets are expecting. But I think, for a long time, markets have really enjoyed this Goldilocks scenario where actually growth is kind of pretty strong, which is keeping solid earnings. But at the same time, maybe the Fed is at least not hiking yet. And I think that could still be a pretty good balance kind of for the markets as well.
Nataliia, it does seem that U.S. tech companies have gotten so much attention that there's a risk, I guess, that they're sucking a lot of the oxygen out there. How do you play some of, the opportunities in Europe?
Yeah, absolutely. If you look into tech, we actually continue to like tech. There is a lot of things to like in tech, especially driven by artificial intelligence. But then when you look into more cyclical areas in the market, we actually like companies in Europe, in Japan, and US mid-stocks. So in Europe, we tend to focus on the largest European companies. So think about, we call them European national champions. So companies in luxury space, companies in industrials, as well as tech, because they benefit from this huge capex that is happening in the artificial intelligence space right now.
So interesting, and we'll get back actually to some of your thoughts also on Japan right now. Bloomberg's Justina Lee, thank you so much for joining us and staying with us. And Nataliia Lipikhina, head of EMEA equity strategy at JPMorgan Private Bank. Now, a couple of things we need to update you on. For example, Reddit shares jumping after improvements to the social media platform's advertising system helped push quarterly sales higher than expected in its first results as a public company. So you can see Reddit pre-market gaining some 13.7%. We'll have plenty more up next. This is Bloomberg. Welcome back, everyone. Now, we're just getting some official data from Apple. China iPhone shipments have climbed 12% in March. Interesting that pre-market Apple is actually getting some 0.4%. There had been, of course, concern about some of that market, as also some of the customers or consumers actually in China were trading down or actually getting more local products. Now, still with us to talk about the markets, Nataliia Lipikhina, head of EMEA equity strategy at JPMorgan Private Bank. Nataliia, thank you so much for sticking around. Now, we're talking a little bit about some of the earnings season that in many cases was better than expected. What are companies actually doing with that excess cash? Are they reinvesting or giving dividends and back to shareholders?
I think what was really the most interesting part of the earnings season last week was the $200 billion capex spent by the US tech companies. It's unprecedented and it's really big. And all of them are in this capex race because of AI. They all want to be ahead of the AI game. But the most interesting part is that it's not just the tech companies that will benefit from it. It's not just semiconductors. That will actually feed through the whole system, especially industrial companies that are exposed to AI, that are also talking about how this capex is already positively impacting their earnings. So we think this is a very, very big theme, not just for this year, for years to come. And AI infrastructure is nowhere near peaking at this point.
And so that also translates in Europe?
Absolutely. There are loads of companies that are actually benefiting from that beyond just big tech companies. We're talking about industrial companies. We're talking about mining companies. All of them have different exposure to data centers and AI.
Nataliia, you also mentioned, you're actually overweight on Japanese equities. I mean, Japan, gives us quite a lot of heartbeat because of values in yen and interventions and what the BOJ does next. Is this a longer-term play?
So if you look into the overall economic stability right now in the markets, US is very strong. Unemployment is low. Consumer confidence is high. And then if you look at outside the US, economic growth is actually picking up. So that itself is very positive for the cyclical parts of the market. That's our preference for Europe, preference for Japan, and US mid-caps. Japan's story is also quite interesting from the shareholders' perspective, because they're increasing their buybacks, similar to Europe, which I think is still very underappreciated by the markets. And also, Japan is really the region that didn't have inflation for a long time. So seeing a bit of inflation in that region is very positive and something that investors are looking for.
Yeah, which is maybe why a bit of yen weakness is not to be snubbed out at. Thank you so much for joining us, Nataliia, today. Nataliia Lipikhina there from JPMorgan Private Bank, going through some of their top plays, including Japan, but also US. Coming up, our exclusive interview with the chief executive of the Spanish car brands Seat and Cupra. That's next, and this is Bloomberg. Now, Siemens Energy raised its outlook for the year and said it would cut jobs and output at its troubled wind turbine business. Also, looking at AB InBev, the world's largest brewer, said revenue in North America fell 9.1% in the first quarter, and that's less than expected. And then BMW down 3%. Earnings actually fell in the first quarter after rising manufacturing costs weighed on the luxury car makers' profitability. So automakers are dialing back their EV ambitions after a few years of surging growth, with orders slowing due to disappearing subsidies, a lack of charging infrastructure, and high EV prices. At the same time, Chinese rivals and Tesla are exposing competitive weakness at Europe's biggest car makers, an issue which has been front and center during President Xi's visit to the continent this week. While Spanish car brands Seat and Cupra are investing heavily in EVs, but the company's chief executive has warned the local market is too small. Well, we're delighted to be joined by Wayne Griffiths. He is the chief executive of Seat and Cupra. So thank you so much, Wayne, for joining us here in the studio. I mean, you have a big job. And you're spending about 3 billion euros to electrify this factory in Montreal. Is that tough? You've never done this. Like, what's your biggest challenge in that?
Yeah, the 3 billion is in our factory, but the whole investment's a lot bigger. Our ambition is to electrify Spain. We're investing as the Volkswagen Group in Spain 10 billion euros. This is an historic investment in the history of Spain, if you like. And it involves not only electrifying our plant in Martorell, but also Pamplona, and building a gigafactory for batteries in Valencia. So it's a real game changer.
I mean, it's quite difficult because you can't, if you had delayed it, people would probably have said, well, why'd you delay it? We need electrification. But it's also a tough environment out there because of the Chinese EVs and lack of subsidies. Do you worry that you were a little bit too quick to push this all-integrated battery supply chain?
No, I don't think there's any point in questioning the objective. We need to get to zero emissions as fast as we can, no? And the European Union has set an objective by 2035 of getting to zero emissions. So I think what we have to do now is try and speed up. We're doing our homework, we're doing our part, we're getting the cars ready. Also cars that are accessible for the masses in terms of pricing. So cars from €25,000, small urban city cars, fully electrified for the Volkswagen Group in Spain. And also cars with autonomy and range, so 400 or 500 kilometers. So I think we need to speed up. There is more competition, particularly from the US and China, and I think Europe really needs to, start to pull together and speed up.
I mean, for the specific plant, I know there was a pushback also from locals, right, in trying to build it. Are you confident that the plans will go ahead, or will it be delayed?
No, there's no going back for us. We start to build cars from next year, 2025 onwards. We're building a battery assembly plant at the moment. That will be, with a 300 million investment, that will be ready at the end of this year. So we start ramping up next year. And like I say, there is no plan B for us. All we need now is more support from the Spanish government in particular to accelerate the sales of electric vehicles, particularly in our home market.
If you look at the cell factory, I mean, again, this is all trade, right? And the fact that some supplies have maybe been delayed, that the supply chain is a lot more difficult than maybe it was 4 or 5 years ago. Do you have the right supply chain in place? Like, are all the components, will they be on time?
Yeah, all the components will be on time because we have our own battery cell factory in Valencia that will deliver cells to us. We have the ability to assemble the battery ourselves. So I'm quite confident that we will have everything in place from our side, from a manufacturer side. Now we need to have the market there, the demand there, and also the charging infrastructure ready.
So what will make a difference, actually, to have that demand and that market there?
I think we need to give the consumers a reason to buy electric cars. First of all, they need to know it's part of the solution for the future. And not have doubts around technology. Is the electric car the solution? We need to get rid of those doubts. And we need the governments to back that as well, not only the Spanish government. And then we need to give the consumers a reason, a motivation, not just a threat or a penalty, that we say you're not going to be allowed to drive a combustion car, but to say why you need to drive an electric car. And give them incentives, incentivize it, make it a smart buy to buy an electric car.
But do you worry about Chinese manufacturers? I mean, they have the full support of the government. There are a lot of them. They can produce cheaper.
I don't worry about them, but I take them seriously. It's increased competition. And, when you are faced with increased competition, you can react in different ways. You can try and defend your position, maintain your position, go into protectionism, or take the challenge and try and be more competitive yourselves. And I think in Europe, that is the challenge we have to take. And we have it in our hands we have a great automotive industry in Europe. We need to protect that, grow that. We could even make it bigger. We have renewable energy. And if we're clever enough to get that renewable energy at competitive prices, I think we could be very competitive against the Chinese, but also the US competitors as well.
But am I right? The Cupra Born is actually made in China and then exported back in Europe?
Yeah, the Cupra Raval will be built from next year in Martorell, together with a Volkswagen model as well, and then other models in Pamplona. So we will be building in Spain, electric vehicles for the Volkswagen Group.
But it's tough. I mean, I guess input prices are much costlier, right? Because labor is more expensive and everything is more expensive in Europe than, for example, in China. So how do you see that stabilizing?
Yeah, the margins are under pressure, particularly at this early phase of electrification. But as I said, we're going to be making electrification with this new range of cars, these small electric vehicles on this new platform for the Volkswagen Group. We're going to make it much more accessible. If you like, we're going to democratize electromobility finally, with cars starting from €25,000, which is the price of the most sold car at the moment in the European market.
So do you think that changes? I mean, again, we talk about escape velocity. At some point, that because enough critical, people have electric cars, then it's the only thing that people will want. How far away are we from that point?
Yeah, the tipping point we said would be 2030. At the moment, it is slowing down, you're right. And what we now need to do is speed up and not talk about 2030 and 2035, but talk about 2024, 2025, set objectives there. Binding objectives for the infrastructure, for getting the infrastructure in place. That's one of the reasons a lot of people have their doubts. And at the same time, make sure that the electric car is the best buy in the market for the consumer.
So good to have you here in the studio. Thank you so much for joining us. That was, of course, the Chief Executive of SEAT and Cupra, Wayne Griffiths, joining us this morning. Now, coming up, we discuss the mining sector, including BHP's $39 billion bid for Anglo American. Our interview with the Chief Executive of the FTSE engineering firm, the Weir Group. That's coming up next, and this is Bloomberg. Well, the U.S. pauses a shipment of bombs to Israel over concerns about damage to urban areas as Israel inches into Rafah. Siemens Energy and brewing giant AB InBev surge after strong results as global stocks continue to stage a comeback. Plus, the U.S. revokes licenses allowing Huawei to buy chips from Qualcomm and Intel as Washington tightens curbs against the Chinese phone maker. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Minneapolis Fed President Neil Kashkari thinks it's likely that the U.S. Central Bank will hold rates until officials are confident that inflation is under control. Speaking with Bloomberg TV at the Milken Institute Global Conference, Kashkari said the Fed will do what's needed to hit the 2% target.
The second half of 2023 surprised us at how rapidly inflation fell. That was really good news, and the economy remained strong. We all hoped that was going to continue. The first quarter of this year, it seems like it stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time. I think we're in a good place right now. Labor market is still strong. We can take our time to get more data to see if disinflation is going to continue. And if it does, great. If it doesn't, then we need to take that on board.
What is the complexion right now of disinflation? What actually drove us, at least down to the level where we're at right now?
Most of the gains that we saw last year were supply side improvements. Supply chains getting better, Americans coming back to work, a lot more workers entering the labor force. That's really positive. I don't think monetary policy actually brought demand down that much. And so most of the gains were because of the supply side. Now the question is, if monetary policy has to take us the rest of the way there, is it tight enough to do that? I wrote an essay today on our website raising that question. And I'm not sure how tight monetary policy is. We need more data to assess it.
How do we know that the disinflationary process has still some ways to go? Or how do we know that maybe this is it? This is the new normal?
Well, it's not the new normal because it's 3%, and the Fed can and will achieve 2%. The question is, if disinflation is still underway, then maybe it'll continue on its own, and we can then take that on board. If we need to hold rates where they are for an extended period of time to tap the brakes on the economy, or if we even needed to raise, we would do what we need to do to get inflation back down.
I have to just ask you, though, about 2%. And I know why the Fed stands by that 2%. But I talked to people around the room this week here, and their cost of capital, they're basing that more on closer to a 3% rate. And the idea is they're saying, look, the 2% target, that needs to come up. That's not the reality long-term structurally, at least not for the folks in this room.
Yeah, I disagree with that. Yeah. I mean, I think that ultimately the central bank, whether it's the Fed or the ECB or the Bank of England, can determine whatever the inflation rate is. And over time, if they conduct their policy appropriately, people will come to understand that, will adjust their behavior. We're committed to 2%. We will get to 2%, and we will get an interest rate environment necessary in order to achieve 2%.
Well, the dollar gained on those hawkish comments by the Fed's Neil Kashkari, of course, putting a pressure on risk assets, including base metals. Now, copper fell below $10,000 a ton, although the metal has rallied around 16% this year on fears of wider deficits, with supply struggling to keep up with growing demand for the energy transition. Now, let's discuss all of this, the outlook for the mining sector, including BHP's $39 billion bid for Anglo America, American, with John Stanton. He's chief executive of the Weir Group, a FTSE 100 engineering company that provides technology to make mining more efficient and sustainable. So, John, thank you so much for joining us. I mean, you're almost like a proxy of everything that we talk about day in, day out. Commodities, because basically you supply the engineering that enables mining companies to extract what they need from the ground. So, first of all, is there an undercapacity because of lack of investment over the last 10 years?
Yeah, well, good morning, Francine. Thank you for having me. Yes, we have a unique position as a company because we serve more mines around the world than anybody else. So we have literally thousands of people working on all the big mines around the world. So we have a unique view of what is going on across the complex. And it's becoming very clear that for commodities such as copper, which are absolutely critical to underpin the energy transition, there is a looming supply gap. It's difficult to see where that supply gap is going to be filled at this point in time. Existing miners are working very hard to upgrade their brownfield sites and produce more, but we need to do that as well as develop new mines from a greenfield point of view to add to the supply and meet the demand that's coming.
So was it a gross miscalculation, actually, that we were not mining enough? I mean, I remember like 2-3 years ago, Jeff Curry from Goldman Sachs at the time, now at Carlyle, came and gave this explosive interview saying, we're running out of everything. Like, how long does it take us to catch up if we're going to put copper in the things that we need to do the transition?
Yeah, well, there's not enough metal. That's, I call it the elephant in the net zero room, is that there's not going to be enough copper to get to where we want to get to unless we see more production come online. I think that needs our mining customers to do more to accelerate the projects that they have in their pipeline. But I think it also needs governments, particularly in the West, to make a policy response, as we're starting to see a little bit, to help them. The challenges are that, the cost of capital is now very high and the payback on mining investments is so long. And, at the same time, it's taking much, much longer for new mines to get the permitting and the licenses they need to operate. And quite rightly so, there needs to be lots of engagement with local communities in terms of the environmental impact, but that's taking much, much longer in terms of facilitating new projects.
I mean, it's interesting, if you look at copper, iron ore is a different story, and then gold's a completely different story, because also it's used for jewelry, but it's also almost a hedge against inflation. So I imagine people are like putting lingots, if not under their mattress, storing them safely. How do you see the other two basically changing behavior?
Well, I mean, I think, again, the exposure that we have as an organisation is that we're very diversified across all of the commodities. Copper, we think, is in a really strong place for the reasons that we've just discussed. I think gold, as a store of value, has bounced back incredibly strongly. So we're seeing our gold mining customers seeking to invest and accelerate their production, which is positive. There are more nuanced and neutral views maybe on iron ore, but here we think the theme is going to be, as we sort of clean up the steel industry and drive for green steel, then that is going to need higher and higher grades of iron ore. So we see investment, and that means more processing, more engineering, more technology to be deployed to deliver on that. So the only things that have been a little bit choppy recently from our point of view have been nickel and lithium, but from our perspective, that was never going to be a straight line in terms of the growth, and I think we're just going through a correction at the moment, but the long-term secular trend is very positive.
I mean, taking Russia out of the equation, who's a huge steel, producer, how has that changed actually the steel complex?
Well, I think it's not changed very much yet, but there is a lot of investment in hydrogen steel, other forms of green steel, moving from traditional blast furnaces to electric arc and other technologies. So I think that's starting to happen. It needs to happen. Steel is a very, very big emitter of CO2. But it's going to require new technology and it's going to require higher grades of iron ore, both of which are positive for us.
John, one of the other things that we discussed quite a lot on the program is, of course, tariffs, but also the fact that there's been a lot of onshoring of business back to the U.S. And I don't know whether we can talk about deglobalization, but certainly the supply chains seem to be getting much harder. Do you see that in your industry?
Well, we've been very fortunate as far as we've always had a regional, vertically integrated supply chain, because we need to have manufacturing that's close to our customers. They want to know that they've got security of supply. And also we did that because we wanted to keep our intellectual property in-house within our manufacturing footprint. So in a way, the world has come back to our model as it's deglobalized. So I think we're in a good place, and we'll continue to refine our manufacturing footprint. But that's where we are today. I think the deglobalization trend more broadly is quite interesting, because if you think about the supply of metals for the future, in a globalized sort of perfect world where supply and demand were broadly met in a somewhat perfect market, that's going to change. You know, we're going to see more resource nationalism, increasingly countries wanting to know that they've got security of supply. And net, I think that probably means that more capacity is built than in a globalized world rather than less. So again, we feel positive about that.
If, BHP Anglo goes through, and it's a big if, and we may have other actors actually wanting to swoop in and buy this asset, how does it change the mining complex?
Well, not for me necessarily to comment on the specifics, but I think M&A that is sort of being mooted at the moment is a positive signal, if you like. It sort of validates the thesis that copper and these other battery metals are going to be important, and it looks like the larger miners want to increase their exposure to that. So I think it's a positive. On the ground, it doesn't really change anything. You know, it's all about the underlying assets, and they need to produce more. They need to become more efficient, more sustainable, and that's where our technology is deployed. More broadly, the M&A may change the ownership of the assets, but we need more assets, and it really doesn't do much to solve that problem.
John, how much do you spend on R&D to make sure that actually some of your equipment is as green as can be?
Well, yeah, since Weir has been through a transformation over the last few years, so we were quite a diversified sort of cyclical conglomerate, and now we're entirely focused on the mining industry, and we did that so we could concentrate our R&D and investment on the new technologies that are going to be needed. Right. You know, very simply put, the mining industry needs to scale up and clean up, and we're going to help them do that through the technologies that we could bring to improve productivity, efficiency, but also meet the increasingly challenging sustainability targets and requirements that our mining customers have.
John, thank you so much for joining us. That was John Stanton, the chief executive of Weir Group. Now, coming up, Beijing's relationship with Belgrade blossoms as tensions with Brussels soar. We get the latest on Xi Jinping's warm welcome in Eastern Europe. This is Bloomberg. Well, China's President Xi Jinping has praised his country's ties with Eastern Europe as a boon for the world's second biggest economy as he arrived in Serbia to bolster links with the Balkan nation. Now, for more, we're joined from Warsaw by Bloomberg's Piotr Skolimowski. Piotr, thank you for joining us. So why did Xi actually choose Serbia as part of his visit to Europe?
Obviously, Serbia is the place that has been very favorable to China. China is its biggest source of FDIs. And obviously, we've just been hearing from President Xi and President of Serbia, Mr. Vučić, who said that the sky is the limit for relations between Serbia and China. And obviously, Serbia has been trying to attract a lot of Chinese investments. There's those deep historical ties that go back to this 25th anniversary of the bombing of the Belgrade embassy, of Chinese embassy in Belgrade, that sort of tied both countries, and they've been working very closely together. And obviously, he doesn't expect to get the sort of unpleasant questions about his support for Russia when it comes to war in Ukraine, or the question about flooding EU markets with cheap goods. Or so that's sort of, as part of his trip, that part is definitely, he's coming to the friendly shores.
So, Piotr, what is he actually then expecting to achieve, apart from avoiding maybe some of the more thorny issues?
Well, obviously, business ties have been very close between the two countries. The two leaders are going to sign about 20 MOUs. Those include various business ties, but also cultural. Already, when we talk about the size of investments, it's 15 billion for both Serbia and Hungary, between China that come from China. And finally, there's also there are a lot of investments that already are bearing fruit. Like, for example, in the copper industry, where Chinese have actually transformed a copper miner in Serbia into a major company. And China is also building a huge, modern high-speed rail between Budapest and Belgrade, which also kind of shows the impact and the footprint of Chinese investment part of the world.
So interesting. Piotr, thank you so much. I know you'll keep us updated with everything that's going on with the Chinese president, of course, on the ground, Piotr Skolimowski. Now, Bloomberg has also learned that the U.S. has revoked licenses allowing Huawei to buy semiconductors from Qualcomm and Intel. Now, the move affects U.S. sales of chips for use in Huawei phones and laptops, marking a further tightening of export restrictions against the Chinese telecom equipment maker. Meanwhile, TikTok has sued the U.S. government over a new law that will force its Chinese parent ByteDance to divest the popular video app or face a ban across the country. Now, the legal challenge sets up what could be a prolonged court battle, pitting free speech rights against national security interests. Well, let's bring in Bloomberg's Mark Bergen. Mark, I mean, this is fascinating. I also think TikTok I think was one of the sponsors at the Met Gala, so the timing of this is quite interesting. But what is TikTok actually arguing in this lawsuit?
Yeah, this is the latest twist and turn, and they've been sort of signaling that they're willing to go to the mat on a legal fight. They're arguing that the ban on divestiture is unconstitutional, that it prevents free speech, and that I think they're making a second argument, like kind of less legal one, but maybe more of a political one, that there are 170 million users in the U.S. There's also this big kind of creator economy that TikTok is part of, and they're saying that this not just risks the many users that are using TikTok and a lot of the young users who are out and voting, but also the people who are making a living off the app.
So what happens to ByteDance if actually TikTok gets shut down in the U.S.?
That's a really good question, one we're kind of looking at very closely. I mean, ByteDance this is not, say, the primary property. They have Douyin, which is their sort of TikTok version in China. I think is just as big and vibrant. And they obviously have, this is sort of a small fraction in the U.S. On the user base, but certainly on the economic and business front, like the U.S., like with all social media, is a dominant market. Their shopping venture, which they're pushing in, competing against Facebook and its properties, that's been having the most traction in the U.S., and that would be a clear hit. So I think this is something that obviously they're wanting to fight as much as possible because it's almost existential for them. So
who would gain from this? I mean, if TikTok had to go away in the U.S., who would benefit? Yeah,
the most immediate benefit here is Meta. If you look at Instagram Reels, it's kind of been called the carbon copy of TikTok. YouTube has its Shorts, which is a TikTok competitor. I mean, that's a very similar product. In some ways, all these platforms are competing for the time of the day, right? There's only a certain number of hours of entertainment information, and so I think Meta and YouTube. Google are probably the biggest beneficiaries of this. By the same token, this is not, these companies, especially Google, have been in positions where they're saying we're not a monopoly on antitrust argument. And TikTok has been amazing politically for them to point to this thing that came up in the past seven years that's now directly competing with them. So it's a very useful political tool in many ways that Google probably doesn't want to go away.
Yeah, so interesting. I know we'll talk about this so much more. Thank you so much for joining us. That is Mark Bergen, of course, following this very closely. Now, former U.S. Treasury Secretary Steve Mnuchin says he's still open to buying TikTok's U.S. operations from ByteDance, while Mnuchin believes the app's algorithm could be replicated in the U.S. Well, he spoke to Bloomberg at the Milken Institute Global Conference in Beverly Hills.
Still very interested in buying it, and to the extent they want to sell it or spin it off, we very much want to pursue that. I support that Congress passed the bill and it's now been signed into law. I will say this has had just incredible, overwhelming support with Republicans and Democrats. This may be the only thing that everybody agrees on. The fact that it's on 160 million phones, I do think it's a security issue.
Does the deal still work if the algorithm doesn't come with TikTok?
Well, the Chinese government has been very clear that they won't give an export license on the algorithm, and I understand that. We have sensitive technology that we don't want to transfer to them, and they don't want to transfer this to the U.S. I've actually spoken to a lot of tech companies on working about rebuilding this. I do believe the algorithms could be rebuilt. So my plan, if we were to purchase it, would be to rebuild the technology under U.S. leadership, make sure that it's all disconnected from ByteDance going forward, and that it is very robust and secure.
Well, that's the former U.S. Treasury Secretary Steve Mnuchin speaking to Wall Street Week anchor David Weston. Now, coming up, earnings top estimates at Disney. Shares in the world's biggest entertainment company, though, slump on its outlook. We'll bring you the details next, and this is Bloomberg. Now, Disney shares tumbled the most in 18 months after it reported a disappointing outlook for growth in streaming subscribers in the current quarter. But the chief financial officer, Hugh Johnston, says price hikes are not impacting streaming negatively.
We took prices up a little bit in the beginning of this year and didn't really see much of an impact. So as to what the future brings, we're obviously very judicious with the way that we price. We want to provide access to as many guests as we possibly can. But we do believe that the great experiences we provide, people are willing to pay for.
Well, let's get more from Bloomberg's Charlie Wells. Charlie, good morning. So Disney reported stronger than expected results, or actually strong earnings, but the share price was down. So what's the disconnect?
Yeah, so it wasn't a fairy tale ending to an earnings report that's actually better than expected. So analysts had been expecting earnings per share of $1.12. Disney actually reported $1.21. And I think something really notable in their earnings report, which investors didn't really seem to care about, was the fact that Disney Plus, that all-important streaming platform for them, was profitable for the first time. But it was really these sort of forward-looking metrics that investors seem to be disappointed by. They seem to be disappointed by a potential slowdown in streaming growth overall, as well as sort of travel normalization to some of these theme parks, which are really important for Disney's business.
So, Charlie, the chief executive, Bob Iger, also just fended off, this battle with the activist investor Nelson Peltz. How should Iger be worried about him coming back or someone else coming back?
I mean, he should be concerned in the fact that there was a pretty significant share price drop yesterday, right? 9.5%. That was significant. Yeah. And one of the points that activists had been making about Disney is that their share price should be performing better. Another issue here was streaming. A lot of these activists, Peltz included, wanted streaming to be doing better. And something striking that Iger said yesterday, he said in a statement that he still sees the overall streaming business reaching profitability, not just for Disney Plus, but for the combined streaming units to be profitable by the fourth quarter. But that puts a lot of pressure on this year ahead.
And very quickly, Reddit, I think the share price is getting more than 10% actually, pre-market.
Yeah, so they beat expectations on revenue. They have been investing in trying to make the site more user-friendly. They actually brought in more users. It was a growth of 37%. So that's really positive for this business as they try to diversify away from just ad revenue and try to sell, the fact that you can use them to trade large language models. And Wall Street responded positively to that.
Yeah, look at that. Pre-market is actually gaining 14%. There you go. Latest up-to-date seconds, of course, live pricing. Bloomberg's Charlie Wells there with the two stocks that we're watching. Now, Bloomberg Brief, it's up next, and this is Bloomberg.